Hi guys, in this video clip, I'm going to demonstrate the understanding and calculation for weighted average cost of capital and the equity return components under financial leverage. By its definition and formula, weighted average cost of capital consists of two cost components, cost of debt and cost on equity. The weighting for the cost of debt is determined by loan-to-value ratio. And there is one additional multiplier for cost of debt, that is 1 minus tax rate. This multiplier takes into account tax shield benefits from interest payment. For cost of equity, the determinant of its weighting is 1 minus loan-to-value ratio. That's the proportion of equity contribution towards this investment. So cost on equity, or we call it risk-adjusted return on equity, can be determined by the capital asset pricing model if we assume the investor is holding a well-diversified portfolio. Under a well-diversified portfolio, only systematic risk will be taken into account. So that's the reason we can utilize capital asset pricing model to get this risk-adjusted return on equity. For the calculation of weighted average cost of capital, let's look at example 1 for the two investments or two properties, investment A and B. Applying the formula, WACC equals loan to value ratio times cost of debt times parentheses 1 minus tax rate. In this case, we assume tax rate is 33%. Then now we have keyed in the cost component for that. Then we need to plus add on cost component for equity. Parentheses 1 minus loan to value ratio, then times cost on equity or risk-adjusted return on equity. To duplicate the same formula for the right-hand side cell, and we do need to fix the location of tax rate because this rate does not change for the other investment. So we add the dollar sign for this cell, then we can pull the cell towards the right-hand side. They just happen, the answer is the same. And then we can reduce decimal places into 2. So for example 2 and example 3 will replicate exactly the same process. Now let's move on to understand the equity return components. For equity return components, especially for property investments, it's very important to understand we have two equity return components, equity yield and equity growth rate. For property investments and the equity yield, under its formula, we understand that's more about the parts from rental income because cap rate captures the certain information of rental income. So the formula shows that equity yield equals this cap rate capturing the rental income minus loan to value ratio times this mortgage constant. And we do need to standardize or normalize the overall term by dividing it by 1 minus loan to value ratio. So applying the formula, let's look at this example. And for under this table, YE represent equity yield. So now we apply the formula here. Equals parenthesis cap rate. So we find the cap rate 8% minus loan to value ratio. Loan to value ratio is over here. Then times mortgage constant, 7% assumed. Then parenthesis, then divided by 1 minus loan to value ratio. So in order to replicate the sales for the following sales, and we do need to fix up those rates that does not change, that do not change for the following sales. So we do need to fix up the location for cap rate, add a $sign. Loan to value ratio will change, and we do need to fix location for this mortgage constant. Right. Then we can pull the formula down and get the answer for the other sale. Now let's look at this, the equity growth rate. So by it means equity growth rate captures the price appreciation part for this property investment. That's why in the formula, the first term is property total return minus cap rate. We can understand it as a part of price appreciation. That's excluding the part of rental income. Right, so then we get this equity growth rate, yeah, because property total return consists of rental income plus that price appreciation. So excluding rental income part through this cap rate, and we can understand that that's the other part is about the property value growth rate. Then the overall part, we also minus those certain costs on loans. So that's how we understand the second term in this numerator. Second term is about loan interest rate minus mortgage constant, and times this the percentage of loan to value ratio. Then for the overall term, we normalize it by 1 minus loan to value ratio. So applying the formula under this equity growth rate, so we use a symbol GE, like consistent with the slide, right? So we have equals. Now we need to add 2 brackets, just following the formula. Property total return. So we found property total return 10% minus cap rate 8%, then 1 parenthesis minus loan to value ratio, then times parenthesis loan interest rate minus mortgage constant, the other parenthesis, then the other one, close up. Then normalize it, divided by 1 minus loan to value ratio, and with parenthesis 1 minus loan to value ratio with parenthesis. Then in order to duplicate the formula, we do need to fix up those rates that will be the same for the following sales. So property total return, we add a $sign to fix its location. Then cap rate, we also need to add this, the $sign to fix its location. Loan to value ratio will change. Interest rate will not change for the following sales. We fix its location, and together with this mortgage constant. So then we can pull down this all the sales and get funding for the other sale. And RE denotes the equity total return. This equity total return can be obtained by sum up equity yield and the equity growth component. Or alternatively, you can apply the formula in the lecture slide, and the equity total return equals this. Property total return minus the cost on the debt part, then normalized by 1 minus loan-to-value ratio. So you will get exactly the same answer as if you sum up equity yield plus equity growth component. So now let's try to apply the formula here. Parenthesis, property total return minus loan-to-value ratio times loan interest rate. Then parenthesis divided by 1 minus loan-to-value ratio. Then we fix the cells that does not change so that we can replicate it. So property total return, we need to fix its location. Loan-to-value ratio will change. Loan interest rate will not change. So then we can pull down this and to get the answer for all other cells. So the key part here to understand from working through of all those different loan levels of loan-to-value ratio, that we do see a clear increase of all two return components, equity yield and the equity growth rate, growth component. Both of them will increase in line with the increasing of financial leverage. And on lecture slides, we also understand that's the key concept. With the increasing of loan-to-value ratio, and we know more and more contribution on equity total return will come from the equity growth component. So that's also summarized on the slide here, and also the chart here shows the same similar trend and similar finding. All right, thank you for your watching.